Blackstone out with fourth quarter earnings just a short time ago. The private equity giant posting distributable earnings per share of $1.71 compared to the consensus estimate of $1.37. Strong investment performance and record cash inflows helping there. So far, take a look at this. Blackstone stock has underperformed the market, but nonetheless, we're going to talk about the market, the results, and a lot of recent deals. John Gray is here. He's Blackstone Group President and Chief Operating Officer. John, good morning to you. I want to get to this conversation about inflation and what Jay Powell is doing, but let's talk about the earnings report first, because it seems like a positive one in a very big way. But then we've been, you look at where the stock is, and there's a little bit of a disconnect, and I'm curious what you think's going on.
Well, Andrew, it's great to be here. I'll start with the results, which were amazing for us. It was the best quarter in our history. It capped our best year. We had $155 billion worth of inflows. To put that in context, that would be a top 10 alternatives firm by itself. Our AUM was up 42% in the last year, and it's being driven by strong results for our customers. That's the most important thing. Best appreciation in our history across a bunch of verticals. And then also we're broadening our platform. We're serving retail and insurance, and still our institutional clients. Retail and insurance are now 40% of our AUM, and that's leading to record financial results you saw. Now, the question on the stock, the way I look at that is the market's just nervous generally. It's nervous about asset prices, interest rates, inflation. We're focusing on executing. We've got a ton of momentum. We feel really good, particularly how we position our portfolio. We think the stock will take care of itself as we continue to deliver.
In terms of what you do next, given where, so let's go to inflation here, because just in terms of the operating businesses, but also what you think the Fed's going to do, because it may change, I imagine, your outlook in terms of what you're going to buy and the metrics around that.
Well, if you step back, thinking about the macro, what's happening now, we're in a really interesting moment. We're seeing both a demand shock to the economy and a supply shock. On the demand side, the government, fiscal and monetary authorities put $10 trillion into the system, and that's driven a lot of spending, housing, autos, travel. People and companies have a lot of money. At the same time, we've got this supply shock going on. So you've got, some of the supply chain challenges, but longer term structural shortages in things like housing and labor and energy. And all of that's leading to this elevated level of inflation. And so when I think about it from an economic standpoint, if you thought about inflation on this axis, growth here, we're in that upper right-hand corner. We're in a higher, inflationary environment. The Fed needs to tighten, but growth at our companies remains remarkably strong. And as we think about investing, we're thinking about that environment. I'm happy to talk about where we're focused.
Well, tell us where you're focused, but I'm also curious about being able to pass on some of these costs to your customers and what margin you think looks like over the next year or two.
Yeah, well, if you think about where you invest, and it ties to that, maybe I'll start with where you don't want to invest. Long duration fixed income, owning long bonds or assets that feel like that. Think about owning an office building with flat rents for the next decade. That would not be great. You also want to be wary of companies that have a lot of exposure to input costs, rising labor and materials costs, and they can't pass on the pricing. Think about potentially a food manufacturer. The good news for us is we don't own a lot of heavy industrial companies. Where do you want to invest? You want to own floating rate debt, shorter duration that goes up as rates go up. That's where our credit portfolio sits. You want to own hard assets. So if you think about infrastructure assets, own transportation infrastructure where roads and airports as demand comes back, or real estate, short duration rental housing or logistics. These are things we're very focused on. And in the corporate world, you want to look for areas where there's really strong growth, secular trends in terms of what's happening in sustainability or green energy. It could be life sciences, the recovery in travel, what's happening in housing. You want to think about the fact that as rates move up, that puts pressure on multiples. And therefore, the way to get growth in value is to own companies and assets where cash flow will grow. Right. And that is really our real focus.
Shepard Smith here. Thanks for watching CNBC on YouTube.